Now that takes us to our talk of the tape. Can the market's pro-growth, risk-on message of the past week be trusted? And how has it changed the setup into the year's final stretch? Let's ask our panel. SoFi's Liz Young-Thomas, MetLife Investment Management's Drew Matus, and Thornburg Investment Management's Emily Leveille. Everyone here with me at Post 9. Great to see you all. Thanks for being Liz. I guess the question here is, it was a pretty assertive, this is what the election means, the anticipated policy mix, pro-cyclical, small cap financial. We've talked about it. Yep. Those also were trends that were in place before, and I wonder if it's a matter of where we are right now as we assess where the markets have gone.
Well, I think, you're right, first of all, to note that the trend was in place before. Yeah. So all we really did was give it more fuel to keep going. And that's what we've witnessed. Now, we've obviously made back a lot of what we pulled back today. I think don't focus too much on the one-day move, right? It's not as if, okay, it's over. We had this big euphoric season, and now we're done with it. I think there's still room for things to keep growing. And you have to also think about the momentum is intact. The internals are strong. We've got 74% of the S&P trading above their 200-day moving average, 68% of the Russell trading above the 200-day moving average. So there's a lot of tailwind behind this. And I have learned the hard way that fighting momentum in this market is a losing battle. So I still think that there's more room to go. Now, yields today sending a little bit of a mixed signal, and I think maybe stocks are starting to get trepidatious about that. I think when yields get to 4.5 and, God forbid, approach 5, that's when it's really going to pressure stocks. And obviously, right in front of a CPI report, I think it makes sense there's a little bit of volatility in the bond market. Yeah,
obviously a little bit of maybe a sensitivity there. And Drew, weigh in on that a little bit, because it's kind of incredible to see the market just decide that we're going to get a reacceleration in growth. The last jobs report was a soft one. That kind of put the Fed on a dovish path. Now we're pricing out rate cuts. And there's this general anticipation that we have a growth-driven move higher in yields. How do you?
Well, look, the trend was in place for employment before the storm-adjusted numbers that came out last. So everyone discounted them. But the reality of it is, the labor market is slowing. We're seeing that. If you look at the small business survey today, there are components of that suggest we should be expecting the unemployment rate to move higher over the next couple of months. So if you talk about, the market thinking about higher inflation risk and then pricing that in the 10-year notes, and the idea that maybe, you're going to get some slowing in activity, but not enough really to get the Fed to kind of move aggressively. The hardest part of the landing is the landing, and you tend to bump around a lot. And I think that's what we're seeing, where growth is going to be slowing. Inflation's going to be somewhat stable, and that means yields are overdone at these levels. They shouldn't be this high.
They shouldn't be this high. So in other words, it's based on a premise of a reacceleration that you're not expecting?
Yeah, you're not going to get it anytime soon, and in the meantime, you're going to get data that suggests that there's actually, to confirm the slowing that we saw before the election.
And Emily, I guess, one of the ways to read how the market has taken the news of the last week is, well, we have one less reason to worry about an outright downturn. Or maybe we're going to give the data a little bit of a wider berth because, we think there's going to be policy help along the way. Has the general investment kind of backdrop changed for you much at all?
Not very much, I would say. We're really focused on investing in companies, not in, sort of broad markets or countries. And I would say, the other sort of, so there's the deregulation part, which is obviously pro-cyclical and pro-business. But then there are these other components to policies, tariffs, immigration, which are actually, and spending cuts at the federal government, which are actually quite counter-cyclical and could be contractionary. And so, when we think about investing for our clients, we want to focus on, okay, where are the companies that are in control of their own destiny, that have the ability to grow earnings through a variety of different cycles, and how are we sort of balancing the growth and industry outlook within our funds so that we're able to provide, positive earnings growth and outperformance for our clients through any economic cycle.
One of the talking points was that companies themselves were saying on conference calls and elsewhere, well, we might wait until after the election for some kind of clarity, whatever that might mean and however that might affect their own business. Do you think that's happening in the companies that you're following, that there's any real kind of shift in priorities or acceleration or pulling back from one area or another?
I do think so. I think you heard this a little bit with some of the, anecdotally around consumer spending and investments as well. We saw it with some of the rental equipment businesses saying, people are holding back on renovations, on maybe smaller projects starting. And part of that is rates, but I think part of it was political uncertainty. So I do expect that could be, a little bit of a boost. But in terms of sort of fundamentally what's changed in the outlook for the economy, I would say that there's a, potential for more inflation on the end of the spectrum where Trump is implementing more of these protectionist policies. And then there's also, the potential for that to have an impact on an already relatively weakened consumer. So we're really focused on, again, investing in these businesses that can grow. Sort of, we saw Shopify today as an example. Companies that can gain share in an environment that can grow earnings because they're seeing great operating leverages in their business. Those are the types of businesses that we want to be invested in for our clients in this environment that feels pretty rich valuation-wise. So you really need to have confidence in that earnings growth continuing to beat expectations. Yeah.